Good morning, ladies and gentlemen. Welcome back to Boutiques on Wednesdays. It's wonderful Wednesday morning. I'm broadcasting all the way from Jan Kemp Dorp. For those of you who don't know, it's about 100 kilometers from Kimberley. Very nippy here, but really good people out here. Today we will have a look at SA fixed income and a thematic flexible fund. It's my pleasure to welcome JC Lowe, Chief Executive Officer at Custodian, who will give us a short introduction to Custodian and how they operate, what they look at, and more specifically, fixed income basics, what that is all about. JC is joined by Paul Fischer, Chief Investment Officer at New Road Capital, who will speak to the Custodian BCI Enhanced Opportunities Fund, a very different strategy to what we used to, but we'll unpack that in a bit more. Good morning, Tracy. Good morning, Paul. How are you keeping?
Morning, Eugene. We are all well, not traveling as far as you are, so yeah, enjoying it.
Good stuff. But JC, I do know you like to travel. JC, we're going to start with you. Paul, you're going to follow after JC. But JC, if I can maybe just by way of introduction, I mean, I've known you almost for 2 decades. I don't know if that gives our age away. You started off managed protected equity funds and balanced funds. I'm not going to mention those fund names, but to you, it's all about risk management. And I would think a lot of that DNA applies to the funds you manage now, especially specifically the fixed income fund that we are going to look at today. I know you've got other mandates as well, a balanced fund, and time allowing, we can maybe look at your balanced fund as well. But we are definitely going to focus on your income fund. And I'm looking forward to see how you combine various strategies in a well-rounded income solution for clients while you keep your eye on risk and what that is all about. I've got your presentation. I can see it. And if you're ready, you can start. Thanks, JC.
Fantastic. Thanks, Eugene. Yeah, I think our age is probably, you can't hide it anymore, all the gray hair. But I think, yeah, thank you for the introduction. I think with a background starting in 1998, touching virtually all the products you can basically manage in this market, ranging from income to equity to balance to offshore. I think many more famous people said it, that when you have a product, your product should service the need of the client. You shouldn't have the best product that you think is amazing and try and sell it to them. So I think in summary, in terms of what our products are about, is it's supposed to service the need. And the need is basically delivered and serviced by the advisor. So we work directly for the advisor with our product, or that's the way we see it. And for the advisor to transfer that product to its client, you need to keep the jargon as low as possible. You can't make it as psychedelic and as fancy as you want. You've got to keep it as basic as it needs to be, because it needs to be delivered to a client. So I guess there are many risks in the market. We'll cover a couple of risks in this presentation, but for us, the biggest risk is the misconnect or the disconnect between what the advisor would then expect from our product and what we actually deliver. And a simple example is if you pick an equity fund for your building blocks, and that equity fund goes 90% into cash, it's no longer an equity fund, and that disconnect between what you're expecting equity returns, and the returns that you actually receive, that's the disconnect we want to service. So predictability, and you'll see the word consistency in this presentation all over and over and over again. So, and it's a weird thing, but if you always sort of average, because there are swings and themes in the market, if you always sort of average actually transforms into excellent if you do it well, just consistently doing what you're supposed to be doing. How do we do it? Well, you know me, Eugene, it's leave your ego by the door. No one is bigger than the market. If you think you're going to outperform the market, get in line, you'll fail. So keep it simple, leave your ego outside, know your strengths. And I think if you look at, again, where does performance come from? It's normally majority. I mean, studies will show you it's about 90% out of your returns comes from asset allocation. So if you just get the asset allocation right, or your positioning or your playground right, a lot of your returns will follow. and then keep your risks low. If you want to manage your risks, simple way to look at it is only take as much you need. If you need to outperform cash, you don't have to take any risks. If you need to deliver a 15 or a 20% return, you'll have to take a lot of risks. So make sure you take just enough risk for the product you are managing. Important one, asset allocation. How do we do it? Well, are we the best asset allocators in the country? No, I will agree. I will admit we're not. So who are? Well, I think if you need to get the asset allocation right, there are many very big, successful, long track record, established businesses doing asset allocation. So why not look at what they're doing? Look at the sector, look at the category, go to look at the 10 largest guys, see what they're doing on a monthly basis, analyze, open the tin a bit, look inside the Tupperware, see if it's still okay. And once analyzed, you can basically mimic or emulate or create a sort of an asset allocation that's an average. It's plain and simple. If you look at A, top right, that's that sort of grayish block in the middle. So you can see the SA large manager 1 through to 10, and you can look at the average asset allocation, and that'll be your allocation. Now, what you can also see on that same A is there's gray and as well as light brown. And so you can break up your returns, asset allocation, as well as selection. So if you get the asset allocation right, say it's 90% of your returns, why not stop there? Okay, but you can add some selection. So let's look at how the guys have done their selection in the past. I'm looking at the CISA Global General Equity, the global equity sector, and we're taking the ACWI, which is the All Country Equity Index, and we can see there's a sort of a 50% line, meaning above that, the majority of the guys can outperform the ACWI. Below that, they failed. So looking at that, you can see over the past 1 year, about 30% of the guys managed to outperform the ACWI. 2 years, again, 30%, and that drops off to, call it 10% over the past 10 years. So only 10% of the managers could consistently outperform the ACWI over time. And it doesn't mean they're bad. It's just, it's a theme, it's an allocation, it's a play, it's growth versus value, for example. So there are times when growth will perform, and there are times when value will perform, and it's then your job as the advisor to allocate between these two. But that's not your job, though. Your job is to service the needs of the client. You need to do it like a needs analysis and a financial analysis for the client, service the client with the product, and remediate and review. So you need to leave the job of asset allocation or switching between themes to the manager or the product itself. And if you know that your selection doesn't carry as much weight as your asset allocation, why not try and strip out the selection altogether? So let's recap. If you could look at the allocation of the largest players out there, you can remove the risk of underperformance or outperformance for that matter, but we can see the guys don't manage to outperform the ACWI over time or their index or their benchmarks. So use the large asset allocation, use the benchmark, buy ETF or buy a tracker. You remove that risk again, and suddenly you've got a very good asset allocation model. You've got a very good selection model without the risk of under or outperformance. You don't have to alternate between value and growth as the advisor, as long as the product follows this guideline. So, and an added bonus is if you use ETFs and trackers, it's typically cheaper as well. So let's look at what the balance fund did, and it's again keeping it simple, no ego involved. I don't have to sound bigger and better than the process. You can see the returns are very solid. Just a quick note in the bottom, you'll see we changed the strategy of this fund to use this asset allocation and use the ETF and tracker model since sort of 2022. So looking at a longer track record won't make a lot of sense. Looking at the past 2-3 years would. Now back to the income. Again, if we can keep that simple, I want to cover the 2 examples on the right-hand side first. And the bottom right, small, but you can probably see. If you could say the interest rates, like we found ourselves in 2021, interest rates are now low. We think the rates will go up. As a homeowner, you're paying about 7,000 Rand on your R1 million loan. You're going to say, well, I'm going to go to the bank and fix my bond because rates are going up. Bank says, well, good, we'll fix you at 7%. And rates goes up by, say, 4.7% in this instance where we find ourselves today. If you fixed your bond, your home bond, your payment stayed at 7.7. If you did not, you would have been paying 3,000 Rand more, or 10,800. It's exactly the same principle. It's just the inverse. If you think rates are high, like we probably find ourselves at the moment, and you can go and secure yourself with a fixed bond. That just means it's going to pay a fixed coupon. It pays a fixed rate when you buy it. And you fix that, say, at 12 or 13% where we are today, and rates fall back to, say, 7% or 4% lower, you would still earn that 12 or 13%. So basic simplicity, fixed versus float allocation in an income fund, you can say if it's going to be floating, the instruments are normally JIBAR or prime or whatever, but let's call it JIBAR plus a certain margin. If rates goes up, you'll get the higher rates plus that fixed margin again. But in the inverse, if it goes down, you're going to slide down and lower. So as you go up, you want to own floating rates. And as the market where we find ourselves now, expecting rate cuts ahead, you probably want to add some fixed bonds. Now, again, let's go back to the egos. Are we the best allocators of credit or floating rates when things are perfect for it? No, there are much better guys out there. Are we the best fixed bond allocators when buying the best bond on the curve? Also, again, no, I'll admit that. And then looking at the chart on the left, you want to see repo versus inflation. You can probably pretty clearly see what should be the next trend going forward. Reading a bit, looking at that chart, you can see the blue line is far above the brown line. The blue line is probably going to drop. So at the moment, you probably want to allocate a little bit more to fixed bonds as opposed to floating. And why not use specialists to do that again? Now, you'll see the Raging Bull award on the right-hand side. This fund has won it in the past. It's done it for risk-adjusted returns, tying in with what Eugene said. My background is all in protected and sort of risk-adjusted return products. So I will stick to the allocation. I would stick to the identification of where we are. I would stick to keeping the product simpler, and I'll use specialists like someone like Paul Crawford and Louis at Fairtree. They've got about 17 odd billion in assets. They will look after our credit, and someone like Philip and his team looking after our fixed bonds and our bond allocation. And of course, I will, together with the team, we'll sort of bring it all together in terms of the allocation, and we will probably slosh between the two products. For example, we might allocate a little bit more to Philip at the moment. Just also be aware, this is not a fund of fund. This is not something which we allocate towards their funds itself. We'll give them a specific mandate, and that's where we come in with, we only take as much risk as we need to. So we would adjust their mandate. We actually pay their salaries, if so to speak. They're part of our investment team, and we will be in constant communication. And then when you say you want to manage the risk in that, why do we adjust the mandates? Well, the biggest risk for you as advisor in an income fund is, what if you use a cash bucket and a growth bucket? You plan for the next 5 years in a cash bucket, your client's going to live off that money, and suddenly my fund, it doesn't actually deliver on what you expected, or the predictability was too low, and you plan for 5 years, but the money only lasts for 3, or your client outlives his own money. And I think that's where we want to get that risk sort of disconnected from your investment. And the risk we can manage is basically duration or credit or liquidity risk. It's self-explanatory. The slide pack will be available afterwards. But what about volatility? It's not there. So let's look at volatility quickly. Again, another simple example. You've got a portfolio A full of sketchy credit, dodgy stuff that doesn't ever trade. It's issued and it just stays there forever. Because it doesn't trade, it's like your house. Your house doesn't trade. You don't know what the price of your house is. That line is just flat. Then you've got a portfolio full of quality, bonds and good credit and stuff that prices and trades, and it's popular, so it trades every day. So the price moves up and down on a daily basis. That fund has got volatility. So if your argument is volatility is risk, in this instance, which one is higher risk? The one with the dodgy stuff that doesn't price, doesn't have any movement, or the one that actually moves? So careful what you perceive to be risks in your product, and make sure you know what you're managing. Duration risk is a simple thing to show we know, like we said, if rates are going to come down and you can make money from it, when rates go down, you want to get your duration higher, etc. Is it my job to manage the duration in the block? No. It'll be, for example, Philip will be in charge of managing the duration. At the moment, the entire duration for the whole fund would be at about 1.7 years. Compare that to the ALBI or the All Bond Index, which is 5.5. We run duration risk. It's about a third of the All Bond Index, yet we can still deliver a running yield of around 11.1. If you can deliver a decent yield with very low risk, that's where Raging Bull risk managed or risk adjusted returns for 5 years come from. And liquidity, again, like we said, this is available. When you look at the look through on the fund, you've got a huge component in government and SA banks. So we diversify our holdings across styles, across themes, but also if it's not in government or banks, the positions are really small. So we've got about 100 non-government instruments, and they average about 0.4 per instrument, if you want to look at that. So our bet sizes and our BN90 limitations are quite strictly followed. And again, like I said, with liquidity management, there's an entire breakdown of what we own. That's using BISA or JSE's daily mark-to-market, and we can see what we own and when we own it. The result of what we do, the consistency of delivering without the ego, keeping it simple, making sure you know where you are, and using the specialist or the right instruments, for example, an ETF in your asset allocation model, and just that's what you need to do. You don't have to do any more than that. And you can see the returns versus, say, the largest and the second largest and third largest income fund in the category. Clearly, very consistent in its returns. And again, this is a single allocation type fund because you already have your two managers in there. We would, on your behalf, switch between, say, bonds and credit when need to. You don't have to do that for your client. Looking at the returns, first quartile, looking at standard deviations, again, first quartile, and the Sharpe ratio, of course, as a result. And finally, looking at the actual returns, we all know that little table in the bottom, you want to be top left, because top left means the higher you are, the better your returns. The further left you are, the lower your risk, measured through volatility, which I just said is rubbish. Anyways, so you want to be top left, and that's a good comparison. And looking at the longer term, the returns are there. So in closing, the two products mentioned, that's the two products we manage. It's the income fund. It's basically in the ASISA multi-asset income category. Specialized managers will be alternating between credit and duration, or between bonds. It will deliver consistent returns and hopefully service the need of your cash bucket, for example. And then the balance fund is just as simple. It'll be in the balanced or the high equity category. It uses the Solemn. And Eugene, just while we're on that, because we analyze the Solemn, we put that in a monthly document, monthly PDF. It's about 2 to 3 pages, where we look at what the guys do, what they've changed, who are the most consistent managers, and should you listen to them? What have they done? So we make that available. You're more than welcome to share that with your clients as well. But yeah, so thank you very much for the slot.
Actually, very interesting indeed. I've got a couple of questions on the fund. But before we get to that, it's a really interesting solution. I think it can work well for a lot of intermediaries. That risk scatter chart that you showed, I think, tells the whole story. Before we get into that, I'm going to give Paul the opportunity to present on his fund. Paul, again, thank you very much for joining us today. Really great to have you, and thank you for your time. Like I mentioned in the introduction, you're going to speak to the Enhanced Opportunities Fund. But Paul, before you start, maybe just quickly, I mean, it's in the multi-asset high equities category, or balance funds. And we know that clients are spoiled for choice there. Lots of options and managers to choose from. But I do think your strategy offers something very unique, where you focus on generating excess returns. I'm not going to steal your thunder, but by combining asset allocation and thematic exposure.
Absolutely.
Very interesting.
Yeah,
Looking
Eugene.
forward to the session.
Yeah, no, thanks, Eugene. Thanks for that. And thanks everyone for your time. We know you guys are busy, and it's always nice to be able to chat to you, and we're excited to talk to you about our fund today. So precisely what Eugene says, the fund aims, it is a multi-asset high equity fund, and obviously that category is, I would say, you know, it's quite big. I mean, there's over 200 funds in that CISA category at the moment. So what we're doing is we're trying to bring something different to the market. You know, you've got your passive investors, and then you've got your active investors. Your active investors are really trying to add value by picking stocks or picking securities, moving around the asset allocations a lot and trying to get alpha that way. And then you've got your passive guys that are saying, well, you know, it's good enough to just have beta exposure, so have exposure to your different asset allocations and use those beta exposures to build out the portfolio. But that's a much more, it's generally a set it and forget it type strategy, you know, so the guys will build an asset allocation and just leave it. We think that there's a sweet spot in the middle of that where you can take the best of both worlds. So you can take the beta exposures and you can manage those beta exposures. So we're a quant-based team. I'm an engineer. My analysts are from maths and engineering backgrounds, using quantitative analysis to really work out how best to allocate those different or how best to put those asset allocations together. And you can, so it's not about moving them around necessarily and tactically shifting them on a daily or monthly basis. You still will run long run strategic asset allocations, but just the way you put those asset allocations together, it's a better way to do it. It's a more active way to do it. And then you can move those asset allocations around as things change on your long run views. So it's not about tactically shifting, it's about strategic asset allocation, but strategic asset allocation doesn't mean static asset allocation, I think is what I'm saying. And then on that, once you've got your asset allocation right, around the peripheries then is looking at thematic exposures to try and get you that excess return. Because if you're managing your risk and you're managing your asset allocations and you're managing your betas, it gives you a little bit more in terms of your risk budget to go out there and start looking. If you're looking at thematics, so now you're not looking at one or two stocks that you're trying to get alpha from. And you're hoping that, you know, your thesis around stock X, let's say, we'll talk about NVIDIA just now, but let's say your thesis around NVIDIA and semiconductors, NVIDIA is the way to go. You're adding a lot of stock specific risk, idiosyncratic risk. Rather look at the theme, rather look at semiconductors as a theme. You can diversify your exposure across various different holdings and rather get exposure to the theme that way. I mean, we also think in terms of trying to work out what interesting themes and what secular trends there are out there. And we talk about trying to find paradigm shifts, which we'll talk about just now. We think that's actually easier to get right than picking specific stocks, because the problem with picking specific stocks is you have competition. So you might be right on your thesis, let's say semiconductors. You might be correct in that semiconductors, you know, is going through a paradigm shift, and with AI and these large language models and all that coming out, that it is the right place to be invested, but your stock picking up your own. You know, you might pick one of the losers in the industry instead of one of the winners. So rather get exposure to the whole thing. So without further ado, getting into the presentation. So just on performance. So, I mean, we run 6 funds at the moment. We've been running funds since 2020. All of our other funds are structured as funds of funds, and that's purely not because we're trying to pick different fund managers. We actually use a lot of ETFs and a lot of passive to get our exposures, but just because we didn't want to hold segregated mandates. So it's just a better way to do it. But this fund we've actually structured as a fund. So out of the 6 funds, it's the only single strategy fund that we have, but it actually feeds into our other fund of funds as well as a building block portfolio. And all of our funds, yeah, we like I said, we started them since 2020. This is a newer fund. It's actually only launched in March last year. So it's what, 15 months, nearing 15 months old now. We're very happy with the performance and what it's done so far. I mean, you can see its total return since inception sitting at 14%. The category average sitting at about 8.3% since inception over the last 15 months. And then if you look at the last year, quite significant outperformance that we got. If you look at where that outperformance has come from, so what we do is we run a lot. So on the locals, in our local exposures, local equity, local property, and local income, we run passive. So we hold very, very passive exposures, and it's just about getting the asset allocation right. We think it's harder and harder to get excess return and alpha out of the South African market. It's quite a concentrated market across the board. I mean, you know, if you're considering the equity market, there's probably only really realistically, for any sizable manager, you know, 100 to 120 stocks that are you can actually invest in where you have liquidity. So it's a very small market. So we're not even trying to get any alpha and outperformance there. If we just get our beta exposures right there and manage the beta, we like 80% there. Where we try and get our exposures is actually in our offshore thematic equity investments. And that's this carve out. So if you look at our offshore equity carve out, since inception, we're up about 35%. If you benchmark that against the ACWI, All Countries World Index, we're about 11% outperformance. And over the last year, also about 11% outperformance. So we're quite proud of that. And that really, you know, where's that coming from? It's coming from our thematic exposure and some of our regional exposures. So if you look here, you know, we do hold semiconductors as a theme. We do hold uranium and nuclear as a theme. That would be that blue line there. And you can see they've done very well for us. Question is, will they continue to do well for us? And we'll talk about that now. NASDAQ, just general US tech or general global tech through the NASDAQ. You know, so these are all holdings that have done very well for us. We've recently made a sort of allocation into the mid-cap, the US mid-cap space. That's more of a hedge. You know, as US stocks become, you could say, you know, on the face of it, they're looking expensive in terms of historic earnings. We think there's good reasons for that. But just to hedge that out a little bit, coming and bringing in a bit of mid-cap exposures as well into the portfolio. But really, this is a new holding for us. But if you look since inception of the fund, we've held these other 3 holdings and they've done really well for us. So if we look at an attribution and we say, okay, well, you know, is that luck? I mean, you know, did you just pick the right things? So really for us, you know, the first thing is getting your asset allocation right. So if we look at an attribution since inception of our fund, this gray line here, there's 8.3. That's the ASISA high equity category average. That's what the average fund has done. We're sitting up here at 14%. If you look at this dark blue would be our performance just based on pure asset allocation. So just taking our asset allocation models that we built and assuming that we just bought your simple market cap beta exposures across the board on asset allocations. That gets us to about just over 10%. So we've actually got about a 2% excess return just from getting our asset allocation right. So that for us is a big win because we want to make sure that that asset allocation is right before anything else. Once you get that asset allocation right, then you can start to tilt it and look at the thematics, which is that light blue line. That's the additional alpha we've got from looking at our thematics. And in that would be things like semiconductors, uranium and nuclear. We had some healthcare opportunities in there that we've removed and subsequently replaced that with mid-cap. Also just general sort of geographical exposure. So we prefer the US. We've been holding the US. We think it's the better of the geographical exposures globally. We think that's probably your least risky and best place to be. That's where all the innovation is. That's where you want to be. And then also just NASDAQ, so tech. And that's given us that blue. But ultimately, we want to be beating benchmark just on getting our asset allocations right. So that would be assuming all our offshore equity was in MSCI ACWI. Would be if we had our same portfolio, just all offshore equity sitting in the ACWI, we'd be here. But then we were able to sort of enhance that with these thematic tilts that we're able to do. And if you combine those two, so you combine your asset allocations with your thematic tilts, you can get really nice portfolio outcomes while still managing risk. And that's the important thing. You know, we're not getting this performance because we went and picked a bunch of mining stocks that were at the bottom of the cycle and mining stocks ran, or a bunch of property stocks that we thought looked cheap and property stocks ran, or something like that. That's not what's happening. We are on the peripheries, around the edges. We're looking at themes, but really the core of the portfolio is about getting that asset allocation right, and that's the most important thing. So if we look at some of the themes that we still like, you know, I've spoken about semiconductors a bit. Our philosophy around theme is we're looking for paradigm shifts. So we're looking for things where you can long run secular trends, where you can invest through a cycle. So you're not worried about the next year or even 2 years. You're really looking at the peripheries of your portfolio. And what that allows you to do is it allows you to hold things through a cycle because you manage your risk by getting your beta exposures correct. So you really don't need a lot of this stuff at the fringes to be able to add a lot of value over time. And what we're looking for through these paradigm shifts, so there's still going to be volatility, you know, you're still going to have the ups and downs in these markets. But what we're looking for is things that have a high innovation component. So that would be the y-axis there. And then things that have a lower interest component, but where that interest is starting to peak and where that interest is starting to sort of become more prevalent in the markets. So you want to get in when interest is fairly low to get into a paradigm, you know, to ride the full extent of a paradigm shift. And we'll talk about nuclear just now. And then you want to ride that interest as it goes through the economy, through the global economy. And that's really how we think about paradigm shifts. And then also making sure that you have that innovation, that exposure to different types of opportunities or different types of innovation in industry. So electrification and renewables, you know, that for us is not a great place to be because there's not much innovation, you know. I mean, windmill's a windmill. You know, these wind turbines today, they're not much different to what the wind turbines were. They're built to different stuff, but they're essentially what they were 200 years ago. And the interest is already there. I mean, you know, there's so much money and subsidy being pumped into these things that it's overcrowded trade really for us. So we're looking at things like where we do think on the energy spaces where there's nuclear, where there's a great opportunity. So just getting into semiconductors as a philosophy, some interesting stuff around there. You know, we spoke about NVIDIA. So if you look at NVIDIA, ChatGPT, so these large language models, and any of you guys who follow this, ChatGPT 4.0 has just been launched. 4.0 standing for Omni, and that's where you've got like a lady that actually speaks to you now, and you can kind of chat to her, and she's very human-like. You can go and Google it or YouTube it and go and check it out for yourself, but it's quite scary. But these large language models, all this stuff, data centers, all this stuff is just, we still believe at the beginning of a massive secular trend here. I mean, if you look, just take NVIDIA as an example, it's data center revenue. So it's chips that it sells from data centers or to data centers. Very different chip to the chip that goes into your PC. You can see what its revenue's done since ChatGPT was launched. I mean, just a crazy jump up, okay? So now you're saying, well, is this sustainable going forward? Well, if you just look at predictions of data, so we all know how much real data just getting added to the internet on a daily basis that these large language models are using to learn. But synthetic data is also becoming a big thing now. And the synthetic data also needs data centers in order to store that data. And what is synthetic data? It would be like, let's say you wanted to train a smart car. You can actually go and build a synthetic model of like a traffic, of an example of traffic in a city, and actually synthetically construct that and train your car using that instead of real world data. So it's things like that. So it's building synthetic data for large language models. It's building sort of subordinate models underneath that. So models that learn from different models. So that would all be considered synthetic data. And you're actually seeing synthetic data, I mean, is actually going to start outpacing the real data that's created on a daily basis. And we all know how big that is. I mean, if you just think about the amount of data that's uploaded to social media on a daily basis, it's huge. Synthetic data is going to start overtaking that. So just looking at these paradigm shifts. So we want to be part of this paradigm shift. I mean, if you look at NVIDIA, it's had a great year. Semiconductors in general had a great year. But if you compare it to others, so I got my analysts to do some work on other sort of paradigm shifts that we've had over time in the industry. And we've just taken one of the stocks. It's not necessarily the best stock, but one of the stocks that just was a beneficiary out of that paradigm shift. And if you look here, PC era, this is a log scale. So you can see that's 10, that's 100. So just looking at that, if you look at Microsoft's growth through that PC paradigm shift, I mean, it went from 1 to 30 essentially. So it went up 30 times. Cisco during the internet era, okay, that was a bit of a bubble. It went up 70 times, but still massive. Apple through the mobile era, it's gone up 100 times. Meta through the social media era, it's gone up about 20 times. NVIDIA is still sitting down here. It's gone up about 5 times since it started its run through this AI era. We still think, you know, if you just had to average what these 4 stocks did through their paradigm shifts, it still has 10x potential. Yeah, we still think this thing is just getting started. If you just, this is a log graph. If we just linearize it, you can see. So, you know, people often think in linearly, but you should really be thinking logarithmically or exponentially. That's what it would look like. So you can see how these stocks have just, sorry, Mom, just freezing a bit, how these stocks have just kind of, you know, gone up exponentially. NVIDIA is still sitting here in terms of where it's been over the last year or two. So you can see, we still think it has a lot of legs. So guys saying that semiconductors are overhyped, we don't think so. We still think that there's a lot of legs and there's something to watch. Can that ride be volatile? Yes. That is why we only look at it at the periphery of our portfolio. We're not going to go and bet the horse on semiconductors. But it's important, if you get that asset, like I say, if you get that asset allocation right, you can have these exposures, these small exposures around that. Just on earnings, semiconductors. So we use a semiconductor ETF. It's about 26 stocks at the moment that runs through all semiconductors in the supply chain. And just looking at earnings. So earnings coming out, NVIDIA's actually got earnings coming out tonight. So if you guys are interested, you know, we're expecting big numbers coming out of NVIDIA tonight. But just if you look at when we printed this, these are the 20 stocks that had reported in that index when we printed this. And if you look at the estimated earnings versus the actual earnings coming out, you can already see it's just generally through that 11% beat on earnings. And these earnings expectations were already quite raised from where they were before. So you're getting earnings going up, and you're getting the beats coming out. So you're getting beats coming out of the expectations, which is also very nice. So that's where you want to be sitting. And we really think with this paradigm shift, for the next 10 years, you're going to be guys are going to be calling semiconductors expensive. They're going to be calling these stocks expensive. and we think they're just going to keep running. Same as what you saw Apple do, same as what you saw Meta do, same as what you saw Microsoft do when they had their paradigm shift. So something we really like. But if we are wrong, we're managing the risk in terms of our exposures by making sure that our beta allocations are right first, and then building this out at the peripheries. Another exciting theme that I wanted to talk about is nuclear. So we think nuclear in terms of, where the globe's going in terms of trying to get clean energy. We don't think it's down here with renewables. We think really the future's sitting in nuclear. There's been a lot of interest, especially after Russia attacking Ukraine. I think Europe, and specifically Europe and the US, have seen this, realize that they've really messed up the energy policy and sort of become energy insecure by relying on sort of, sorry, just the light coming on here, unstable regimes around the world to sort of pawn off the responsibility of sourcing energy from. And we think that's kind of rolling back now, and they've realized this, and they've become a lot more pragmatic around their own energy security. If you can see just some of the legislation and things that have come out over the last year. So regulatory wise, the US has actually released 2 acts that are making it a lot easier to restart and re-kick off nuclear construction, nuclear power plants in the US, and the G7 as well. In the last COP28 conference, the environmental conference, also just reaffirming their backing of nuclear. So it's been quite a shift change. So we talk about getting this interest factor to change and move across, and that's what you're starting to see now with these legislation changes. If you look at some of the big companies, so Constellation, it's a massive, it's the biggest holding in our nuclear energy exposure. It's a nuclear energy producer. They've Vogtle 3 and Vogtle 4 have just come online, 2 of their nuclear reactors, and these 2 nuclear reactors combined are now the biggest source or single source of clean energy in the world at the moment. If you take those two reactors. Microsoft just signed a deal with Constellation on having a nuclear energy powered data center, and Amazon has done that as well. So recently they just bought a campus next to a nuclear power plant for a data center for $650 million. So you can see that's starting to happen. You're seeing this interest. I mean, if you look at nuclear, you can see that this is just nuclear plants being built in the US. You can see the last commissioned ones were actually before 2000, and then recently you've had Vogtle 3 and Vogtle 4. This is another plant that it took a while to come online. It was actually commissioned about 10, 15 years before this. But you can see there's been no trends, no nuclear for a long time, and now you're starting to see nuclear come back online. So we're very excited about this. We think it is the future of clean energy. You can just see in the states, some of these green states are all the states that are looking at providing incentives now, actually for green energy. Not for green energy, for nuclear energy to come on board. And these are some of the projects that have been planned and proposed and are starting to come online. So, those are just 2 of the themes that we really like at the moment that are feeding into the fund. But like I said, the main thing is our asset allocations. This is where the asset allocations of the fund sit at the moment. So local equity, we're talking about 42%, local in total about 66%. Then we got local bonds at about just under 20%, local property, and then our global exposures. And these are really where we're trying to get most of our sort of excess return over and above getting our asset allocations right. So you can look at some of our themes. So we've got, big exposure to the US. We still like the US. You could argue it's a little bit expensive, but that's, we're starting to hedge with the mid-cap space. It's looking a lot more attractive if you look at earnings, but we still actually think that probably there's a reason that the S&P 500 is running a little bit expensive, and we think that earnings are going to catch up. If you look at the earnings, if you watch the earnings come through, earnings even just in the general market are beating expectations quite substantially still, and that's coming through quite a lot. We like US tech. We've got emerging market exposure. Then we've got our semiconductors and our nuclear. So you can see, even though we really like these themes, excuse me, the 2 themes together are about 6% of the portfolio. So it's not. In a lot of actively managed funds, you could have, as much as 5 or 6% in one stock. So we're trying to move away from that stock specific risk and just looking at the themes in totality. So between those 2 themes, there's about 53 stocks at the moment that would sit in that 6%. So yeah, that's where the portfolio sits at the moment. Just from a costing point of view, before I wrap up, the fund, we aim to keep our costs low. The total TRC of the fund at the moment, this is including transaction costs, sitting at just over 100 basis points. So that's all in costs. That's everything. Very cost effective. You can see sitting down here. So these will be sort of more your passive funds, and then your active funds starting to come up here. Like I say, we're trying to sit somewhere in the middle. So you got a really good, this fund over the last year is 9th in the category. So it's a top 10 fund in the high equity category, but also really, very cost effective fund as well. So it's not like you're overpaying for that performance either. So just something to touch on, if you can save some returns by saving on fees, you should do that. You should be looking at that as well. So yeah, that's where we are. Very excited about the fund. If you'd like to get hold of us, please, you can get a hold of me or the team, and happy to have any further discussions if you would like. But yeah, thank you for your time, everyone, and all the best, and good luck for the rest of the week.
Paul, thank you very much for that. I'm going to keep on putting strain on your voice. I'm going to continue with you, JC. I'm going to come back to you just now.
Perfect.
Very interesting indeed, Paul, and I'm really glad you brought up the fee conversation, because if you look at the average funds, actively managed funds, there where you've got multiple strategies, you're probably looking at about 160, 170 basis points, where you're coming in at 100. So very aggressively priced, and that comes through from some of the actives you use in the portfolios to get to those themes. Maybe just back to take a few steps back onto your asset allocation. You showed that one slide on where your asset allocation sits at the moment. But if you can maybe just unpack that a little bit more as to how you get to that asset allocation, specifically the global component, because that's where a lot of your excess returns came from. But you're only sitting at 34. If I look at some of the other multi-asset high equity funds, some of the big brands out there, the guys pushed through to 40, some of the guys fully invested 45. How do you get to your onshore, offshore asset allocation, since that is such a big component of your returns as well?
Good question, Eugenia. So what we do is it's a very quantitative process that we use in terms of setting up our asset allocations. What we found is if you start to include too much offshore, you start to increase the volatility of your portfolio without necessarily increasing long run returns. You must remember, so in South Africa, we don't just have equities, we've also got bonds. And local bonds are offering you a very high yield at the moment. And that actually can add a lot of value in terms of a portfolio construction, in terms of building out your portfolio construction. So if you're going to go offshore, now you've got to decide, are you going offshore equity or offshore bonds? Offshore bonds are giving you a decent yield. But if you go in the US, our offshore bond exposure is predominantly US and G7, but mostly US. You don't get 4-5% yields. That's what you can expect in the long run. Maybe you get some currency. It's hard to predict what the currency is going to do. If you get currency weakness, probably get a little bit more there. But you're getting 10-11% yields in local currency, which is pretty. Nothing's guaranteed, but it's pretty. Over a 4 or 5 year period, if you buy a bond at an 11% yield, the chances of you getting 11% on that bond are fairly high. So, you're going to get over time, you go through a cycle, you're going to get the yield on that bond. So when you start incorporating all the different exposures together, so it's not just about local equity or offshore equity, it's about local bonds, offshore bonds, local property, offshore property as well. When you mingle them all together and you start to get offshore too high in your portfolio, it just starts to add volatility without actually adding any return outcome, essentially. We think you can get enough of the return. If you can manage the asset allocation, you can afford to take bigger bets in terms of your thematics at the fringes, because you've already managed your risk exposure in terms of your beta exposures. So, for example, what an active manager would have to go and buy specific stocks, and the decision of the stock holding itself is almost ties into the asset allocation holding in a way, because if they decide to go and buy, let's say, Microsoft versus Sasol, that's an offshore equity versus a local equity. What we're saying is, first just get your asset allocation right. And then you can actually, once that asset allocation is right and you're managing your risk in terms of your beta exposures, then you can go and buy like a semiconductor theme. We know it's going to be volatile, but you can just hold that thing through. And what that enables us to do is, even though there's only 35% in offshore and only 30% of that is offshore equity, you can still get significant outperformance. And if you look at our offshore equity carve-out, we've gotten 11% outperformance over the last year, which is phenomenal. But it's because we are able to take those bigger exposures within that carve-out, because we know that we've got our asset allocation pool right, if that makes sense. So it's really about just managing. It's about, you don't want to have too big of a bet either way. So you also don't want to have no global exposure, because then you're not getting the diversification benefit. But that diversification benefit, as you have bigger exposure in your portfolio, it starts to become no longer a diversification benefit. It starts to become, well, that's a big component of your portfolio now, and it's highly volatile. So it's just now just adding volatility to your portfolio. So if that makes sense. So the 35% comes from quantitative analysis and trying to put all these things together. And it can change in the future. It's not fixed. You know, we talk about strategic asset allocation. If our long run expectations of asset classes move around, that'll move around as well. But we're not going to shift it because we think it's cheap or expensive. It's going to be a long run strategic shift based on long run expectations. That makes sense.
And it totally does. It's probably one of the better answers I've heard on asset allocations on the multi-asset high equity fund. Just around themes, you spoke a lot about the themes that you've got at the moment. At first glance, you know, if you look at the themes, it's very high concentration to the US. How do you come up with all those themes? And does it broaden out to, you know, a bigger world other than big concentration in the US? You know, for example, developments are taking place in emerging markets. If you look at what's happening in India and regions like that, do you continuously look out for themes there? How do you bring that into a portfolio?
Yeah, so we're continuously looking for themes. We have ideas generation. When we sit down in our investment committee meetings, we're looking at different ideas. We have, you know, research coming in from different research providers that also assist with that and helping us, you know, just in terms of getting idea generation. We try and keep it very simple. It's quite easy. It's actually very easy to go quite, I don't want to say esoteric, but to get quite, you can start getting quite deep dive into different thematics, and you can start kind of losing the wood from the trees a little bit in terms of what you're trying to achieve. So we're very cognizant of trying to keep it simple and trying to have, you know, I've talking about the paradigm shifts. So how do you know, we want to see those almost obvious paradigm shifts. You can see them. There's these obvious, you know, we like to think that they're pretty obvious. I mean, there's obvious paradigm shifts. You know, social media was an obvious paradigm shift. PCs were an obvious paradigm shift. You know, you didn't know where it was going to go, but you knew something was happening. We think that, let's call it the AI revolution, is an obvious paradigm shift. We think nuclear is an obvious paradigm shift. So looking for those obvious, but there's not many of those out there, and they don't come all the time. So you've got to keep your eyes peeled and look, but you also got to be willing to hold. You know, we think a lot of managers these days, they're shifting their portfolios around way too much. You know, even an active portfolio with a low portfolio turnover is sitting at 50%, which means its average holding is 2 years. That for us is not investment time horizon. That's a trading time horizon. You know, we want to be able to invest and run these things over long periods of time. So it's looking for those paradigm shifts that can give you, that you can hold for 10 years plus and hold them. So we don't move around. I mean, a recent change in the portfolio would be the mid caps. So but that's more of a hedge against, let's call it, you know, we are quite exposed to the US. So we're bringing in the mid caps just as they're a lot more, they're a lot lower rated than your larger cap stocks. So that would be more of a hedge. It's not really a thematic in terms of a paradigm shift, but that's more just a portfolio construction hedge. But there we did have exposure to genomics and healthcare as a theme, but we sold that out. We still think, yeah, that was sitting in the portfolio, but we sold that out. We just think that the thesis kind of had it moved away from what we were looking for there. So we thought there was actually that it had moved too far in terms of that. We were talking about that interest in the innovation. We think it had moved too far across in the interest space. And we still think there's potential there, but we'd need to see a big re-rating before we got back into that. So we are looking for these themes, but we don't want to get caught up in just looking for themes for the sake of looking for themes. We do like, you talked about geographics, so India, Japan, you know, we had a big discussion the other day about, do we include Japan in the portfolio? We decided against it. You know, there's a lot of reasons why potentially you'd want to look at Japan. There's been a few changes in regulatory changes and things around there, bigger focus on profitability in terms of listed companies there and things like that. It's forcing their managers to have sort of make better capital allocation decisions. But we decided against it because it didn't seem as obvious of an opportunity to us as like semiconductors does. We think that that's an obvious.
Right.
We don't think you need to be a rocket scientist to understand that. So,
no, absolutely.
So,
yeah. Paul, very interesting indeed. The clock is catching up with us very quickly. A lot more, I think, that we need to discuss or can discuss on your fund. Very interesting strategy from the audience question there. The fund's name, the New Road BCI Enhanced Opportunities Fund, available on most of the big platforms. If you need more information on the fund, more than happy to get you in touch with Paul. Before we go away, JC, you've been waiting very patiently. I'm so sorry. Very quickly, I just want to come back to your income portfolio and the strategies that you follow there. You spoke about your bond allocation that you hand over to Philip Bradford from PMX. We know very well. Credit that you hold in the portfolio with Fairtree, Paul Crawford, also well-proven strategies that's been paying off for several years now. But how do you get to that mix in terms of what do you allocate to who? And do you sometimes change managers, or who do you decide to give what to?
Yeah, it's a good question, Eugene. I think, we would probably find, if you're going to alternate between the two managers, like I said, if you can get the major cycle correct, or you just plop your investment in the right playground, you'll probably do well. So if you keep things extremely simple and you sort of take one step back. I always made fun of my dad, who was like head of portfolio management at Sanlam. It was almost as if he made decisions from a calendar as opposed to a watch or a ticking screen or something. So if you take one step back and you say, where are you in a macro cycle? Am I the best economist? Hell no. But you can clearly see when rates are peaking or rates are bottoming, for example. That's just the simplest example you can take. And when you want to participate in a rising cycle, you need to go for floating. It's going to actually participate on the way up versus on the way down. We have changed managers in the past. We've had big names and exotic names in there. And I think we've settled on Paul and Philip. And it's like, you and I have known one another long enough. I think after 20 years, you almost like look through the screen and all the marketing, and you figure out who are the very good guys to run what you need. And like I said, it's if I need a certain result, that's where I would go with them. Now we would alternate, yes, a little bit. For example, we would be at say 53% to Philip at the moment and 47% to Paul. It's not because he's the worst manager. I think it's just the end of credit is probably closer than what the gain for bonds would be. And again, then to second guess what the best bond manager out there would be with all his pedigrees and his awards. He's a good manager, so let him be. However, we would, credit is a good example. We might limit the amount of exposure to low credit or low quality credit. And again, are we the best credit managers? No, but we know what kind of risk we want to take. So bet sizes, portfolio construction is important. Like I said, it's been 20, 25 years for me. So a well-constructed portfolio with very good managers in there, or with very low-cost ETFs to get the cost down. That's where we want to focus.
Okay, I think you summed it up right there at the end. So if clients are looking for a well-rounded income solution, I wouldn't call it a fund. It's really a solution for clients where you cover most of the moving parts, and given where we are in cycles, keeping an eye out on that, really something to consider in client portfolios. So if you don't want to manage all those moving parts, then consider a fund like the Custodian BCI Income Plus Fund. And you've showed some slides on your balance fund as well. Unfortunately, we don't have time to go a little bit more into that, but similar kind of thinking and really interesting strategies as well. Paul and JC, thank you so much for your time this morning. Really interesting conversation with both of you, getting a bit more exposure to both your businesses. Really interesting. All the funds are available on the major platforms. Again, thank you for your time. We'll chat to you again in the very, very near future. To our audience out there, just a quick reminder, I'm not going to see you next week, Wednesday. It's national elections. So please make your voice count. This is a time to say your say with regards to SA's governance. But we will see you next week, Wednesday, the following week, Wednesday, on the 5th of June, with our global equity managers, T. Rowe Price and Martello Asset Management. Because it's the global managers, we'll start a little bit later. We're going to start at 9, the 5th on June, and we'll take our conversations further then. To JC and Paul, again, thank you so much for your time this morning. To our audience, looking forward to chatting you, and keep well, keep safe.